best strategy for our clients that we've recommended is you just want to be a long-term holder. But most people don't approach crypto that way. Most are trading it and want instant return. The work by our technical strategist, Mark Newton, so he thinks Solana, Ethereum, and Bitcoin all have downside. He has been bearish since mid-January. So I think it's been correct. And his downside target for Bitcoin is 62,000 by the end of March. But to me, is 62,000 a reason to turn bearish on Bitcoin? I mean, if you're trading it, yeah, but Bitcoin was $1,000, well, $100 10 years ago. So, 60,000 is still a fantastic return. And I think Bitcoin's usefulness is still improving. I don't think it moves. It's still a risk on asset. So I don't expect it to do well if the market is being hit by tariffs. Like it's not immune to that kind of turbulence. But is the trust around Bitcoin going to grow over the next 5 years? Yes. And is it going to be increasingly viewed as a store of value like gold? Yes, I think increasingly. And then is there room for a lot more people to own it? Yes. So I'm not really bearish on it, but I think in the near term, it's hard to say it should go up right now.
Yeah, you do a lot of correlation work, and this is purely anecdotal on my part. It seems very correlated to the NASDAQ 100 right now. Is that fair to say?
Yeah, it makes sense. It's a risk on asset.
Yeah. Let's just kind of take some stock of the whole conversation a little bit, because you've been very bullish for a while, and you've been right. Does 2 months cause you, we're kind of basically, let's say the S&P is unchanged, the NASDAQ's down a few percent, we're 2 months into the year, there's a lot of uncertainty about, we talked about immigration, tax, tariff, geopolitics, the list goes on and on. Things are likely to cool out a little bit at some point, right? On that sort of front, we get some of that uncertainty out of the way. How are you thinking, just if you want to put it in a nutshell, the economy this year? It sounds like you think rates should go lower. You think inflation is probably not going up much higher. And then generally, how are you thinking about the stock market?
I mean, the market is trying to price in a lot of these uncertainties right now. And so it's understandable that we're churning. But investors don't want to become too bearish, because the market sentiment, and it's already measurable, like the AAII survey, which is what we've used for the last 14 years. I think it's the best retail sentiment survey, is at the same bearish levels it was in the fall of 2022. So retail sentiment, and it's probably because there's been a ton of margin calls last couple weeks, is at the levels that were at the depths of that recent bear market. So the investors view this as a crisis when it's really a growth scare. So to me, I think there's a good chance we're making our lows for the first half, like this week. And
like down 5-6%, you mean?
Yeah, it could be.
Yeah.
I mean, the only thing is I'm not that optimistic about the job picture for the near term. So maybe that's one last leg. But the reality is that a lot of bad news has gotten priced in. And, on the flip side of this is that the closer we get to stall speed, the more the Fed has to get off neutral. And I think the White House will have to back off talk of things that could be hurting the economy.
Do you think we're going to get a 10% pullback in the S&P this year? Because we did have one July highs to the August lows, and things kind of accelerated into that August low, and it felt a little panicky. And again, since then, we haven't had too much panic. I think that move in December after the Fed meeting, that felt really bad. But we were not making, it didn't take long to make new highs.
Well, I think that July to August was essentially, I would say, Fed driven.
Yeah.
And so that makes sense, because it felt like either the Fed made a policy error or the Fed turned hawkish.
Right.
But either way, we had a big drawdown. Will that happen this year? I mean, yeah, I think it'll happen. If I'm guessing, it's more in the second half. So I think this is just a flesh wound right now, not the source of a drawdown.
Okay, so flesh wound, how much upside do you think if we get a lot of those headwinds kind of out of the way, a lot of those uncertainties we just talked about? Let's say we get the base case on that kind of pro-growth agenda that a lot of folks were excited about.
Let me be clear why I don't think it's 10%. Because let's say that some policies implemented that would cause the U.S. stock market to go down 10.
Yeah.
I'll guarantee you the rest of the world's down 30.
Right.
So will Europe and Canada, Mexico dig in and we'll just power through this? No, they're going to capitulate. So the reality is that this brinksmanship probably means the other side caves in. So Bitcoin is down. But it's our clients, it's actually not a surprise to our clients because Mark Newton, our head of technical strategy, really pointed out the cycles in mid-January that he was targeting 62,000 for Bitcoin by the end of March. So we're actually on our way to 62, but that's not a bearish development. It's just a retracement. And the third, of course, is small caps, because once the tariff talks go away, the environment is favorable for American-focused companies, which would be, small companies, and they'll benefit from lower rates and their multiples are lower. So I think it's still a big opportunity. But in the middle of tariff talks, none of these groups can really do that well.
Well, when we come back, Dan's going to get a little granular with you and we can continue this conversation. So stick around, folks.
All right, one area that we did not talk about yet on policy was the idea of deregulation, and we know there's a bunch of sectors that should benefit from that. To me, I think this is a curious situation because there was an article, I think at some point in January, it was the worst month for deals. I love that expression, deals, you know what I mean? And again, we had not even had the inauguration yet, and we hadn't even had policy in place. But the idea was that you're going to have a lot of these industries that had been, had yokes around their neck or whatever. And then you had big cap tech with all these DOJ and FTC investigations unable to make, strategic M&A and the like. We have a huge backlog for the IPO calendar, that sort of thing. How important is deregulation on all of those levels that we just talked about as you think about an economy that should be continuing to move along at 2.5+% GDP?
It's important because there is regulatory cost in the economy, right? Like it is a tax and friction on movement, but I don't know how to titrate that, meaning I don't know if zero regulatory cost is good for the economy, because of course that is when fraud and bad practices come. Even looking at the SEC, do we really want the SEC to have no enforcement, right? Because we know that people take advantage of that. So I think it's probably a case where less is better, but I don't know how much less.
Yeah, and if we got through some point, I guess, in Q2, mid-part, and we're just not seeing M&A, we're not seeing S1s being filed for IPOs, we're seeing, a lot of this DOJ and FTC action against the large cap tech stocks, that hasn't gone away. There's been some kind of commentary around the fact that, that some of the stuff that was started under Trump 1.0 and really picked up steam during the Biden administration as it related to mega cap tech is not going to go away, And so I think about, I don't know, man. Like, I think if that was one of the pillars of this pro-growth sort of, outlook, you start losing the pillars, and then you say to yourself, what is the economy? How does it inflect? How does it start to reaccelerate? That's the one thing, Tom, I can't put my arms around. We're going to talk about generative AI. I think a lot of that CapEx, I think that's obviously been a big driver on a lot of economic activity, clearly in the stock market. But X that, before we kind of drill down on that, what are the sorts of things, like, is it, tariffs going away? And like, what is the sort of thing that kind of causes the economy to inflect higher?
The economy's not that simple. So it's kind of hard when people realize we're talking about a $30 trillion economy, and like a 2% change is not, several $1 trillion. It's a couple $100 million change. So that's why data center thing or building a plant actually moves the needle on a $30 trillion economy, because it adds to GDP growth. But the biggest lever probably to pull is the 10-year yield needs to fall.
Yeah.
Because, 100 basis point move in the 10-year yield, dropping mortgage rates back into the, fives would be a huge impulse. And stock market going up creates wealth effect too. It does create inflation, but it does create wealth effect. The ISM manufacturing's been below 50 for 26 months. It finally turned above 50 this past January. That's the longest stretch since the ISM was created. Even during the GFC, it was only below 50 for 16 months. So we know that confidence of purchasing managers is low, and that means that people have probably been rationing capital.
Yeah. All right. Here's another one. This could help the stock market because we know what happened in 2017 and 18 when we got those tax cuts. So we haven't even talked about tax cuts yet. You have this budget that looks like it's moving forward. In that is maybe $4.5 trillion of tax cuts over the next 10 years. When we had that in 17, I think it was to the tune of $1.5 trillion what did corporations do for the next year and a half? They bought back $1.5 trillion worth of stock, right? So is that something that you could see as being, a tailwind to the stock market if we get this kind of tax cut? I think that's something that really kind of powered gains in the markets back in 17 and 18. And back then, the Fed was raising interest rates, and really everything was going great until we had that growth scare in the back half of 2018. So how important are tax cuts, at least psychologically right now, but then as you think about as we get into 26 for the economy and for the markets?
People want tax cuts, so when they get it, they're happy. I think these days, markets are going to question how it can be afforded. I think that's one of the problems with tax cuts now, is that the consumer might like it, but it might backfire in the bond market. But it comes back to, there has been caution on corporate expansion, and you deplete capital stock, right? So the base of capital in the US, I'm guessing the number, but it's probably like 50 trillion. If you depreciate over 7 years, it's a couple of $1 trillion a year of capital stock depletion. So unless you're investing at that rate, so capex to depreciation, you actually have to rebuild capital. That's what I think, that depletion happened because the Fed's been so tight.
Yeah, one of the other areas, and I'm glad you brought that up, the whole idea of reshoring, right? And so if the, geopolitics is going to get ratcheted up, which it clearly is, at least with China right now, the idea, and we learned this during COVID, the kind of supply chain is a thing of national security. Then you think about all these export bans that we're having on chips, and you're talking about where they're manufactured. Might China make a move on Taiwan because they know that they make, 85% of the high-end GPUs that they can't even get, right? That sort of thing. So that's inflationary, right? If we see a big move. Now, you tell me, we got Stargate, we got Apple saying $500 billion, we got all this sort of stuff. We've seen this before. We didn't hear these announcements when Biden came in, you know what I mean? But we heard them in Trump 1.0. We're hearing them again now. And when the rubber hit the road in 17, 18, 19, we just didn't see a lot of that kind of, Foxconn was coming to Wisconsin. Remember, they dug a hole and then nothing happened. So I'm curious, how much weight are you putting on some of these early announcements as it relates to reshoring?
There's one thing if Congress passes a bill and it's like provision, because everyone's going to spend it.
Right.
It's another thing when companies make announcements. I used to cover stocks for 15 years. And I remembered people would be like, Tom, look at all the layoffs announced. And they'd be like 100,000 at AT&T. And then you realize it's like attrition. They're not counting part-time hires. And so, you never know the real number.
Yeah. But by the way, in 2022, a lot of folks were counting all the layoffs that were happening in Silicon Valley and the like, and that ended up being the best thing that happened for the stock market, if you think about it, because some of those stocks got hit so hard. Meta, for one, Meta was down 70%. Think about it. Tesla was down 70%. NVIDIA was down 70%. Netflix was down 70%. And so I just feel like, until those companies started rationalizing costs, the stocks couldn't work. And once they did, but we're in a different situation now, and we can talk maybe a little bit about generative AI, because the whole promise here is productivity gains, right? Is that you can do kind of more with less. So we're going to eventually see job cuts. And there's some companies who've been talking about this a little bit. So when you have this thesis, and you've been covering, I know you covered tech, going back 30 years, right? You keep hearing this again and again, that, technology is this massive deflationary force. This technology is going to be the most deflationary force. So speak a little bit about that, how you're factoring in, let's say you're this year and next year, how you think about the economy in general.
First, AI doesn't have a ceiling. So you might hit super intelligence, and then you'll hit super intelligence. And all of a sudden the worker, an AI worker, is like, and 200 IQ PhD student that is cheaper than hiring a part-time college student or whatever. And so AI is replacing labor. It's going to be productive, as you said. It can probably accelerate discovery. And then probably the fourth thing AI does is it really collapses geographic borders, because communication is seamless now. And like when people say AI, like I saw Microsoft saying that the measure of AI success is GDP growth goes to 10%. That's more discoveries happen or language barriers collapse, but it's not worker replacement,
Right.
because that's contractionary. So I think that the most tangible use case now is actually labor replacement, because companies can show ROI on that.